The S&P 500 has dropped to important chart support in the 1640 area, and we think this level will get taken out as this pullback or correction continues. Hi, this is Mark Arbiter with S&P's Chart Room. Taking a look at a daily chart of the S&P 500, we talked about the head and shoulders top being broken recently. The size of the head and shoulders was about 35 points. So we then said we could see a measure move down to about 1642. So far we've gotten to about 1639 and change. This morning we gapped down and we've gotten as low as 1638 and change. So we're at very important short-term chart resistance. We think we're going to take this out. As you can see, this rally failed near the 50-day and near the 13-day exponential and 34-day exponential. So we think we're going to take this level out. The next piece of potential Fibonacci support comes in around 1636, just below current prices, and the 61.8% retracement from the rally from the June lows comes in around the 1617 level. We also have this key longer-term trend line support comes in around 1630. That goes back to the lows from the latter part of last year. As far as short support, there really wasn't a lot built up during this move off the June lows. There's a little here in that 1620, 1630 area as we get down towards the 1600 level. That was basically the only consolidation we had during this pretty fierce up move. So the danger here is if we break the 1640 level, that we could see a fairly swift decline down to 1600, perhaps challenging the June lows. Right now, I think the higher probability for us is down towards the 1600 level before we bottom out and then reverse to the upside. We had a negative or bearish moving average crossover with the 13-day exponential moving average crossing underneath the longer-term 34-day exponential moving average. This is certainly a warning sign from an intermediate-term basis. The last time we saw this was back in June here, and that actually corresponded right with the lows in June, so that one didn't work out too well. The prior one occurred back in 2011, and that worked out really well. So as most indicators, you know, sometimes they work and sometimes they don't. It's just a warning sign to be careful here in the short to intermediate term as things unwind. So we're staying cautious here until the market gives us more reason to be optimistic as we look out further this year. This has been Mark Arbiter with S&P's Chart Room.